evening, friends. My name is Kamal Manocha. I represent PMS AIF World. We are a new age wealth management firm helping investors not only invest and take informed investment decisions. We have been running this webinar series called Crystal Gazing Next Decade of Wealth Creation for Investors. In this series, we have invited some insightful money managers and discussed a lot of discerning topics. Today, we have Mr. Prashant Khemka from WhiteOak Capital Management, and we'll be doing candid discussion with him on the state of economy, on the markets, on his views, and also on the India Pioneer Portfolio Management Service. I'll give a brief background to Mr. Prashant Khemka. Mr. Prashant Khemka comes with 22 years of experience. He started his career in 1998, and before starting WhiteOak Capital Management, which he started in 2017, he was associated for a long period of time as a CIO and lead fund manager with Goldman Asset Management. WhiteOak Capital Management has been there in India for last more than 3 years, and they have more than 3-4 portfolios. We will be particularly covering today India Pioneer portfolio, the philosophy of WhiteOak, and also, we'll also be taking questions and answers after Prashant would have covered his presentation. Over to you, Prashant.
Thank you, Kamal. Thank you for having us here on the webinar, and thank you all of you who dialed in to share your Friday evening with us. From tomorrow onwards, I think all the evenings will get quite busy with IPL starting tomorrow. So Kamal has slipped this one in just in time. As Kamal suggested, we would probably for the first 20 odd minutes go over the our WhiteOak's background and the portfolio background and philosophy and whatnot, and then maybe open up for questions. Kamal, is that fair?
Absolutely, yes.
So to give some background about WhiteOak, and maybe my team can bring up the slides, also the presentation deck as well on WhiteOak. We are a little over 3 years old as a WhiteOak as a firm. June 17 is when I started. 40 people now on the team, 16,000 crores in AUM. Lower right hand side chart, you'll see about 3,000 of those are from India and 13,000 are from outside India. Half of the assets are from institutional investors like sovereign wealth funds and pension plans. The remaining half is from HNIs, ultra HNIs, foundations, charitable trusts, and so on. The reason for the greater skew towards foreign investors at this time is because for last 22 years, I've been dealing with and interacting with investors globally. To get a little bit more about my background, I grew up in India, started investing in Indian equity markets in 1985 when Rajiv Gandhi took over as Prime Minister. The markets rallied 100% in 85. Till date remains the best year in Indian market. And I got sucked in as a retail investor because my family always, parents, grandparents always invested their savings, all their savings in equities. So since then, the bug has bitten me, and have always been fully invested. 100% of my net worth since then has been invested in Indian equities. I went to the US for further studies in mid-90s and then joined State Street Global Advisors as assistant PM on global equity portfolio. Then joined Goldman in US equities, where I soon became senior PM and co-chair of investment committee, and then returned to Bombay to start their India business, GSAM's India business. Launched GS India strategy in March 07, which I managed as CIO and lead PM till April 17 when I left. And along the way, I was also made CIO and lead PM of global emerging markets, which also I managed till April 17. And then I left to start WhiteOak. Here at WhiteOak, we've put together a very strong team, which has delivered a fantastic performance. I'll start straight away with performance on slide 59. We have, in a market that's been very, very challenging to managers, and investors alike. As you'll see on the left-hand side on this slide, in the bottom two rows, if you see cumulatively, markets delivered only 12% return, the middle column, S&P 500. Our team has delivered 49% return. The line above that shows 4% return annual, 3.9 annualized, and our team has delivered 14.2 for an outperformance of 10.25%. This is in a market where mid and small caps have underperformed, and hence most managers, by some counts, 80% or so of managers have underperformed. You see the next slide, all of this outperformance, first of all, this performance has been very consistent. 9 out of 13 quarters outperformed, 4 out of 5 down quarters, as well as 5 out of 8 up quarters. In the next slide, if you see, it shows performance attribution by market cap. The dark bars on the left-hand side show the stock selection-based outperformance. On the right-hand side table, if you look at the bottom row, then gross of fees and tax, team generated 56% return compared to 12 of the benchmark for 44% outperformance, of which 73 came from stock selection. Allocation effect was, if anything, minus 29. Now, allocation effect is a zero-sum game over time. It's a luck, byproduct of luck, which cannot be counted upon, where stock selection is typically attributed to skill of the team. So if these figures were the other way around, where stock selection was poor and allocation effect was high, that would have no real significance in terms of team's capability going forward. However, here, stock selection being very strong, it bodes well for teams' skill set. In each category, you see large cap, the team delivered 64.9, which is the second column, first row, 64.9 compared to 24% of the benchmark. In mid caps, they're up 99% compared to minus 10, and small caps also were up 67%. Very healthy outperformance. If we go to next slide, same is true from a sectoral perspective. On the left-hand side, you'll see every sector more or less is almost all sectors are positive in terms of dark blue bar, which are stock selection. On the right-hand side, again, if you look at the rightmost 3 columns and at the bottom row, 51 out of 44 has come from stock selection, with allocation effect being minus 7. Go to next slide. It shows some of the names that have done extremely well for the team. Left-hand side are the top 10 contributors: Larsen Toubro, Infotech, InfoEdge, Naveen Fluorine, LTTS, Muthoot, IPCA, Nestle, Fine Organics, JB Chem, and NIT Tech. Coforge is the new name of NIT Tech. Obviously, we've had some detractors as well, as you can see here, Delta, Dishman, and so on. Important point to note here is that contributors are far larger than detractors. So the top contributor, 693 basis points, is 7 times bigger than the minus 99 basis points of the top detractor. And so on for the other names as well. So position sizing by the team and risk management has worked out very well, in that contributors are much larger, detractors have been contained and not allowed to dig a big hole in the performance. Also, you'll notice these are very well distributed. No single name is driving, or no, it's not that a couple of names are driving all the performance. So law of large numbers is at work, which should give confidence in the fact that it's not it's more skill based and not potentially luck driven, which might be the case if 1 or 2 names are driving all the performance. Third, I would say that not a single name which has any material, and obviously this is subjective, but you don't see names like, I don't want to name, but many companies in the last few years went down 80-90% due to poor or disastrous corporate governance. Those names don't feature here, and I'll come to expand more on that in a few minutes. If there is a character of the portfolio that you can infer or conclude from looking at these names, it's basically that it's a portfolio of companies that are either industry leaders or dominant players, like InfoEdge, which has 70% market share in Naukri.com, or Muthoot Finance, which is a leader in gold-based lending, or Nestle India, which is large number of products which have very dominant market share, be it Maggi or infant formula. So these are either industry leaders and dominant players, otherwise gaining market share like LTI and Coforge and other names here, or Naveen and others, gaining market share within Indian peers or global peers. And this is on the back of very strong management execution, which drives then superior growth compared to industry or compared to the corporate world in general, while generating superior returns on capital, and maintaining robust corporate governance. And we buy them when there is substantial upside, and own them when there is substantial upside to fair value based on our proprietary valuation framework, which I'll elaborate in a few minutes. So maybe we can go now to the slide number 6, to generate and sustain strong performance over time. And we've only shared with you 3 years performance because WhiteOak's 3-year-old. Obviously, my performance track records much longer, and has been top 1 percentile over the last 13 years, as well as the last 3 years here at WhiteOak. So to generate and sustain over long periods through cycles, strong performance, it's prerequisite to have focused and strong investment culture, what we call performance first culture, meaning that the sole driving factor or purpose is to generate highest return for our clients compared to anyone else in the peer group. And this is based on, this is founded upon these 4 pillars of philosophy, team, process, and portfolio construction, which are aligned with one another, meaning it's a stock selection based philosophy of investing in great businesses rather than betting on macro. To go with it, we have a team that, in my subjective opinion, is the best team in the industry of stock pickers, implementing a time-tested process at the core of which is our proprietary analytical framework that's developed over more than 2 decades. And all along, from a risk management perspective, we maintain a balanced portfolio, which consciously avoids or aims to avoid top-down macro bets. Not only we don't seek macro bets, we consciously avoid macro bets to ensure that performance is a function of stock selection, as you saw in the performance attribution that we just talked about. So maybe we'll speak for a few minutes on particularly the team and philosophy, and then can, during Q&A, talk more about process and portfolio construction, depending on how the time is. So on the team, not to go into, in the interest of time, individual's background, but first and foremost would like to highlight it's the most well-resourced team in the industry. 13 people, average dozen years of experience. In contrast to many where you have 1 or 2 people at the helm who are senior, here there are very many people with multiple decades of experience. Some of us have invested since been invested through Harshad Mehta scam in the 90s. Many of us in .com bubble, and then Lehman crisis, and now the COVID crisis. So if I were to step back and summarize into 3 key attributes about the team, aspects that are unique to the team. One is, as I was just mentioning, deep bench of seasoned investors. Second, extensive global experience, unlike any other peer, if you will. I myself have managed at very senior level for 8 years developed world portfolios, either US or global equities. And for 4 years, global emerging markets equities from Korea to Mexico. All these countries are ahead of India by varying number of years or decades in terms of their economic development. And so having that perspective is very useful. Having that pattern recognition capability that develops over time, over a dozen years of investing. So over these dozen years, I would have evaluated 2,000 companies or thereabouts in terms of evaluating them for investment purposes outside India. And that those insights and experience is very, very useful. And not just myself, there are other individuals like Kamlesh, Ramesh, Rishi, and few others who have extensive investing experience in countries as far as Latin America, Africa, Europe, and Asia. So extensive global experience. Third, team within team structure of research and decision making. So unlike most teams where you have one person covering one stock or industry, on our team we have two people assigned to every stock. So two pairs of eyes covering every company and every sector. So for example, Manoj and Sagar jointly cover pharma. Ramesh and Ayush jointly cover technology. I had implemented this on my global emerging markets when I was managing that at Goldman. Found it to be very effective, and hence implemented here at WhiteOak from day one. So to summarize, three key and unique attributes is deep bench of seasoned investors, extensive global investing experience, and team within team structure of research and decision making. Collectively, these attributes make the team uniquely equipped to generate the kind of returns that they have generated. The shared philosophy of the team, next slide, is that outsized returns are earned over time by investing in great businesses at attractive valuations. So two key elements are business and value. You may be thinking every manager says the same thing. Now that is a fact of life. It's a centuries old game or profession or art, you may want to think of it as. And there's no silver bullet. You have to do some basic things right and do them consistently. Just because it sounds simple, it may not be simple. It's like, we all know that to have a healthy body, we need to eat well, sleep well, exercise, and have a stress-free life. And that simple formula hasn't changed for centuries. Yet, very few of us can do that, these four simple things consistently beyond the first few days of January, following the New Year resolutions. Similarly, in investing as well, the devil lies in details and execution. When it comes to that, what we consider as great business is one that has these attributes of superior returns on incremental capital. It's scalable and well managed, both in terms of execution and governance. These are born out of the fundamental value equation, which is that value is equal to present value of future cash flows, which can also be written as value is equal to cash flow divided by R minus G. Let's look at each one of these attributes now. Superior return on incremental capital. If I'm sure many of you run businesses or own businesses, you would agree that to generate cash flow sustainably, the return on future capital, incremental capital, must be higher than cost of capital, sustainably so. Otherwise, cash flow generation can't be there over time. So that's very basic. Scalability is about sustainable growth, or the G in the value equation that I mentioned. Many industries are scalable, yet others are not. Worldwide, newspaper business was scalable for the entire of the 20th century, but over the last 20 years, globally it's been in decline because of online competition and substitution. And in India also, it's a matter of time where it will go in decline. The other industries also which may face existential threat, like many of the businesses which are involved in combustion engine food chain may face similar existential threat in 20 to 30 years time, unless they evolve themselves into a suitable other business models. On the other hand, many companies, many industries are very scalable. In India, look at private banks. Right now, they're quite beaten up because of COVID-related credit cost concerns. But private banks over the last 20 years in India have compounded at over 20% in terms of loan growth and whatnot. Because credit penetration is low in India, in an economy that is growing double digits, penetration is increasing, double digits meaning in nominal terms, low double digits. Credit penetration is increasing, and private banks are gaining market share from government-owned banks, which still have 2/3 of market share. And hence, private banks have grown collectively at about 20-odd%, approximately speaking, the better ones at least. However, just because you have the opportunity for superior ROIC and scalability, that's not done. You also need management that can execute to deliver from a long-term value creation focus. There were many banks that were given licenses in mid-90s. Not all have succeeded. Several of them, struggled and had to be bailed out, like initially GTB and then Centurion Bank and Bank of Rajasthan and so on. Over the years, there were several. Whereas on the other side, HDFC, Kotak, ICICI, and so on have created lakhs of crores of franchise value. And the differentiator was the execution DNA of the organization. And we as a team spent enormous amount of time assessing these attributes and particularly also focusing on execution DNA and governance DNA. Because even if all the other attributes are there, but governance is not adequate, then it's a great business only for the controlling shareholders, not for us minority shareholders. And the best way to make money then is by avoiding them altogether. So many companies we haven't invested ever. One of the reasons why we haven't invested in government-owned companies over the last 3 years as well. Because not just talking about India, but having managed global emerging markets, I've seen from countries from Korea to Mexico, everywhere government ownership is, to put it mildly, associated with lacking or poor governance, if you will. There are a lot of problems in a lot of private companies as well. And as I said, without naming individual companies, I would just say that our team has done a fantastic job avoiding all of those governance disasters over the last few years. And that has played a key role in key contribution to the performance over the last 3 years or even longer time period. And to that end, we do over 2,000 meetings in any given year. Not only with company managements at various levels of the company management, but also their competitors, listed or unlisted, their suppliers, distributors, regulators, oftentimes ex-investors, private equity investors, or ex-employees are very useful, provide very useful insights. And to all these meetings are to assess these various attributes of a company. And when we find companies which possess these attributes in good measure, it's then very important to logically value them and have the discipline or patience to buy them only when they are available at a substantial discount to fair value or at an attractive price. Now, so valuation is very critical. Now, I know many people say that if you find great businesses, you can buy at any price and over time you will do well and outperform. And I don't argue with that. That may very well be true. But as we keep reminding ourselves on the team, our aim is not merely to outperform the market, which is to say to be above average. Our aim, as we keep reminding ourselves, is to outperform the best performers in the market. And this valuation sensitivity adds the extra few percentage points, which are very crucial to outperform the best outperformers in the market. So we are very valuation sensitive in our investment process. And when we say valuation, we are, but not at all concerned about PE multiples. PE multiples, EBITDA multiples, these are very distorted and hence very misleading and in fact harmful in the way they are generally used. What we focus on instead is DCF value and cash flow multiple as derived from our proprietary framework, which is depicted here. So any company in this framework, we would analyze it, in this format. You can take any company. Let's take Balkrishna Industries as an example. We don't own it. It's a company we used to own in the past. But Balkrishna Industries can be split as Finco and Opco. Finco is where we will house fixed assets and working capital, plant machinery, and then inventory, finished goods, and all that. Revenue and EBITDA would be assigned to the OpCo, from which it would be deemed to pay a fixed asset rental charge or an operating lease cost for use of fixed assets, and a working capital financing charge for use of working capital. So very simple, you split into two companies, revenue EBITDA assigned to OpCo, pay to the Finco for use of fixed assets and working capital. The cost, embedded cost, So there's an amortization element in fixed assets as well. Just as when you lease a car, you make a payment which includes the amortization element and a financing cost element, and then the working capital financing cost. The financing cost element is equated to cost of capital of the company, which at current time we take 11% post-tax, 16% or thereabouts pre-tax. After paying these and after paying taxes to the government, what is left is capital light free cash flow. It's called so because all the capital resides in Finco. And this cap light free cash flow captures basically the excess return on invested capital in the business because the cost of capital has been paid out to Finco. And the present value of these cash flows basically is the present value of the OpCo, which is basically the present value of excess return on invested capital in the business. Whereas the value of Finco is simply the value of the dump capital, the invested capital. It is one-time capital because cost of capital equals return on capital, so growth is immaterial. So it's simply, if let's say in this Balkrishna Tire example, if 1,000 crores is the capital invested, then 1,000 crores is just the value of Finco, and anything over and above that is value of OpCo as an example. So this is a way of separating the value into two components, one which is highly valuable, which is excess ROIC, and the other is which is very low value, which is just dumb capital. It's like if you have a pot of curd, the value of the curd really is function of how much butter that can be derived from it. Just by looking at the curd, you may not be able to value it properly, but if you churn it, you can separate the butter and water. So this is a churning framework, if you will, which separates the more valuable OpCo component from the Finco component. So in case of Balkrishna, for example, more than 80% is in excess ROIC or OpCo, less than 20% is Finco. So that's very insightful because for every dollar that Balkrishna consumes, it's able to generate more than $4 of excess ROIC value. And when you are investing in the stock of the company, basically only $1 out of $5 is blocked into the low value IC and $4 is towards the excess ROIC. On the other hand, there are several tire companies which are not so good in their capital allocation. In fact, for let's say Apollo Tire, it's the other way around. 80% is in invested capital and only 20% or so in this framework is in OpCo or excess ROIC. So therefore, every dollar that you invest, only 25 cents, or every dollar company consumes only 25 cents is excess ROIC value. And 80% of your investment is blocked into dump capital, if you will. So on PE multiples, Apollo may appear as 10 to 12 multiple, and Balkrishna may appear to be 20 to 25 multiple. But when you separate the Finco and OpCo, you'll see that on OpCo, the multiple, which is the bottom equation that you see here. So in the first equation, EV is equal to IC plus value of excess ROIC. It's just the Finco plus OpCo. That's the enterprise value, DCF value. When you substitute the terms and rearrange them, you get what is the price to free cash flow multiple of OpCo in the second equation, which is the market implied value of OpCo divided by the free cash flow of OpCo. When you view it from that perspective, Balkrishna Industries would be about 30 to 35 times, 33 times call it, whereas Apollo would be in hundreds of multiples. Very, very expensive because they have hardly any cash flow left in OpCo after paying cost of capital. If we were to go quickly to slide number 26 and see what these multiples are for Sensex. In the lower right-hand side table, I hope that's visible, Kamal, or should we expand it?
This is visible. This is visible. I am on my laptop. I can see this visible.
Okay, great. So if you look at the lower right-hand side table, the bottom column, sorry, the bottom third row from the bottom is Sensex multiple of 23.6 times. But on the capital light cash flow multiple, as we just discussed, the multiple is 42.7 times. Call it 43 times. Now, 43 sounds high. Remember, that's cash flow multiple after paying cost of capital. It's always in the high 30s, low 40s, not just in India, but also having done this for countries like China, Indonesia, US and all. In my prior roles, the multiple tends to range in the 30s or even low 40s, regardless of what the PE multiple is. What it is useful though is in comparison. So let's say like Apollo Tires was a 10 to 12 P multiple, which is half the multiple of the market P wise, and Balkrishna is similar multiple as the market. Whereas on a cash flow multiple basis, Apollo is very, very expensive in hundreds of times, whereas Balkrishna would be 25% lower multiple than the market in average. Similarly, Nestle, a company that we bought 3 years ago, and 3 years ago it was trading at 45 multiple on PE multiple, whereas market was at 20 PE multiple. So people would say, oh, it's at 125% premium, great company, but very expensive, no thanks. Whereas from a cash flow multiple perspective, as we discussed, because for Nestle, nearly 99% of the value is in OpCo and 1% or less is in FinCo, the cash flow multiple and PE multiple are very same. And so cash flow multiple was 46 times compared to market cash flow multiple at that time, which was 38, 39 times. So Nestle was at a premium, but at a 20 to 25% premium only. That's like Mercedes. If it is a 20 to 25% premium compared to a Fiat, then that's an attractive deal. And so Nestle was very attractive from not only that perspective, it was attractive from a DCF value. It was showing good amount of upside, and was also attractive compared to other companies in consumer staple universe like Colgate and Pidilite and Asian Paints and Unilever and all those. So we bought a good chunk of Nestle. It was a top weight in consumer sector and also one of the largest weight in the portfolio. So that's quite an extensive summary of our philosophy. As I said, in the interest of time, I'll skip the process and portfolio construction unless there are questions. What I would talk about here while we are on this slide is what the portfolio looks like at the end of last month. You'll see in the top half the sectoral mix. We are very well allocated across most sectors except for energy and utilities. We just don't own anything in energy utilities, nothing from a top-down perspective, but they're dominated by government-owned companies, large number of government-owned companies, which we don't feel comfortable about governance. And then there is Reliance, which we have missed because of our focus on, accounting and understanding the accounting properly. In case of Reliance, we're not saying that accounting is poor or anything. It's just too complicated for us to understand. And if we can't understand accounting, we can't value a company. We can't value a company. We can't make the decision to buy. So that's discipline has hurt in case of Reliance, which has been a rock star of a company. But that discipline has helped the team across portfolio through time to deliver the kind of performance it has delivered despite not owning Reliance. On the lower left-hand side, what you see is the current portfolio market cap mix. 2/3 of the portfolio at this time is in large cap, 1/3 is in mid and small cap. Usually you should expect 30 to 50% as the range of mid and small. Right now it's lower, just simply because a lot of our mid cap names have done extraordinarily well over the last 6 months and have migrated into large cap category without us doing anything, basically. So if you go to the team's performance been very strong year to date as well, which we didn't highlight, but if we go 3 or 4 slides earlier to just show the year-to-date performance as well. Prior slide, yeah. So you'll see on a year-to-date basis, the portfolio is up 6% compared to market down 4% for 1,000 basis points of outperformance. And a lot of that performance this year has come from, if we go now to the individual stocks, I want to highlight. Yeah, you will see on the left-hand side, quite a few mid-cap stocks have done very well, like Larsen & Toubro Infotech, which is the second name on this list. Cipla, third name on the list. Then Muthoot Finance, Abbott India, Torrent Pharma. All these were mid-cap companies at the start of the year. And because of very strong 30, 50, 70% kind of return in a fairly weak market, these have migrated from being mid caps to large caps. And hence 10 to 12% of the mid cap weight has gone to large cap. And hence, mid caps now look like 17, 18%, which is pretty much the lowest it has been in a long time. And otherwise, we expect about 30% to be in mid caps and about 10 to 15% in small cap for about 40% in mid and small on a going forward basis. That should be a reasonable expectation. So I will just pause here. This is just year-to-date contributors and detractors. What we showed earlier was 3 years performance contributors and detractors. What I showed earlier was for 3 years, and we can leave the screen on this one and open for Q&A.